Thanks for coming. I know, 9:30 on a Sunday morning in Chicago. You don't necessarily want to drive downtown, particularly when it's raining. So I appreciate everyone coming. I'm Jay Soloff. My company is Investors Alley. My primary product is Option Profit Engine. So just to explain what those titles are, this is 5 secrets to trading options like a professional trader. So now normally I gloss over the stuff about me. People want to get to the interesting stuff, but I'll just stop a minute because I live in Arizona now, but my start came here in Chicago. I was a trader on the CBOE market maker back when, almost all option trading was done in the pit format before it was electronic. So I got my start here. Now you can see, maybe, it's kind of hard, that's an old picture that I scanned, but I usually tell the joke that people think that maybe I look like this, 40 pounds heavier with a lot more gray hair. It's because I was a trader. It's actually not true. It was because I had kids. So this is me post 2 boys, and yeah. So anyways, for the last 8 years or so, I've been doing this online research, newsletter, education aspect of it. Originally I was on the floor, which gave me an interesting perspective on options, something that is not necessarily normal in the newsletter industry. But anyways, so I've moved on, and this aspect of options gives me a chance to talk about a lot of the things that I've learned, and gives me a little bit of perspective that maybe others don't have who didn't get thrown into the fire, so to speak. All right, so were you all trading on February 5th? Or is anybody aware, were you guys watching the markets then? Because it was a very meaningful day. Now, meaningful for a couple reasons. So this is just the Dow, and you can see that on February 5th, that's the day we had from the high to the low intraday, we had this 1,500 point drop, all right? So it was meaningful in the sense that it was the largest point drop in history for the Dow. Now, it wasn't that meaningful in terms of like a crash, right? Percentage-wise, 6% is a lot. 6% is a lot because we have had several years of really nothing going on. We had very low volatility environment for the last few years. So when we have a day where we have a 6% drop and a couple, big down days around that, it was very meaningful. But in terms of Dow 1,500 point drop, it really shouldn't have been that major of an event. I mean, if you talk about 1987, that was a 23% point drop. So 6% is nothing. It's not even sure if it's in it's in the top 100 of worst point drops per day, but I mean, if it is, it's barely, right? So it was a meaningful day, but mostly just because things had been so quiet, not because of the actual point drop itself. Now, meanwhile, how many of you are familiar with the volatility ETFs or ETNs like VXX? Does anybody trade those? I mean, so if you were a volatility trader, this is SVXY. So VXX is your long VIX, your long short-term VIX ETN, right? It takes the first 2 months of futures for the VIX and it puts it into an ETF for people to trade. The inverse of that was XIV or SVXY. Now, the reason I'm not showing XIV is because that inverse ETF or ETN blew out. It did not survive. Right? SVXY barely survived. It dropped 80%. So the Dow dropped 6%. The inverse volatility exchange traded product dropped 80%. One of them dropped 100%. XIV, which was the most popular one, disappeared. It did not open the next day and then never opened again. So what happened? Why was a bad drop but not a catastrophic drop? Why did it end up blowing out an inverse volatility ETP, and why did SVXY go down 80%? Well, part of it is mechanical, right? So these exchange traded products, they're required to balance their portfolio by buying and selling VIX futures at the end of every day. So what happened is that people started panicking, and it cascaded into people getting out of their positions, and the firms, based on their prospectus, had to buy a certain amount of futures and sell a certain amount of futures. So it just ended up being this situation where they couldn't do it. Like there weren't, let's say they had to buy futures. Well, there was nobody selling. So the buy price just kept going up and up and up, and eventually these exchange traded products couldn't handle it. So institutions were fine. Right? They have other ways to hedge. They just call their buddy over at the brokerage firm and say, hey, I need to get out of this position in the after hours, boom. Most institutions made money. It was the individual investors that got killed in this situation. A lot of people who were short volatility traders, which was an extremely popular trade at the time, they got hammered. A lot of people lost everything they had made in the last few years as a short volatility trader. So that could have been avoided, right? Not losing money on the short volatility trade. I am generally a short volatility trader, so I lost some money when this happened too. But I was extremely protected. My goal as an option trader is basically always give myself an out, right? I want to be able to trade tomorrow. So these 5 things that I'm going to show you, a lot of it just has to do with making sure you can trade tomorrow, right? You never want to be in a situation where something like this happens. It's fine if something like this happens. Most people didn't see it coming. It's all right. You lose money on a situation like that, so did most people. But you need to be able to recover from that. So this was a very meaningful thing. I went to the CBOE's risk management conference soon after this happened, and this is all everyone was talking about at the show. But the institution, nobody there that I talked to lost money. They were all protected. So, but before I get to this, I usually get questions asked about the resources, where I grab my charts, where I grab my back tests. Let me tell you, if you want a copy of this presentation, my colleague is handing out a clipboard. Just write your email on there, and we'll send you one. So these are all really good resources. Most of it's free. MarketChameleon.com is where I pretty much do all my volatility analytical research. The vast majority of the stuff, most of the screeners, almost all of it is free. For more advanced traders, they have some premium features, but it's a small company that is really, they were former market makers and they decided to go into the analytics side, and it's great. They do a great job, and I still can't believe that most of it is free. And even the premium price, it's like maybe $100 a month, is totally worth it if you're more advanced. So that's a great site. I'll have some charts from there. The other one, cmlviz.com. It's really the only back testing site without having access to like a Bloomberg terminal or something that's like $2,000 a month. For something like $50 or $100 a month, you can back test just about any option strategy. So you'll see I use the back testing in this quite a bit. And then just for education, sites like optionseducation.org and CBOE have a lot of really good free resources for stock screeners, FinViz, for stock charts, and almost all this stuff is free. So you don't have to spend a bunch of money to get most of the information you're going to need to be a decent trader. Okay, so number 1. All right, well, good. So this is the most important thing I'm going to tell you, and it has nothing to do with a certain strategy or anything like that. It's trade your edge. I was told this a lot when I was a professional trader, and the funny thing is that I never, it took me about 20 years to actually understand what it means. So options are amazing because there are a million ways to trade it. There's all the long, short spreads combined with stocks. I mean, there's a zillion things you can do. And I'm going to tell you that there is no wrong way to trade options. Right now, given given intelligent risk management, right? I'm not saying that you should buy a bunch of, if your strategy is buy 1,000 5-cent options hoping for a lottery ticket move, that is not a good strategy. But in terms of, people will tell you as an options trader, oh, you can't make money being long options. You can only make money selling options. I know people, professionals, who mostly buy options. What works for you, what's in your DNA as a trader is what you should do. If you're not comfortable being a short volatility trader, basically I'm a short volatility trader. I'm most comfortable doing that. When I start to try to pick directions and things like that, I'll run in trouble. I will make money on that, but not as much as I will if I focus on selling volatility. That's what I'm comfortable with. I use mostly iron condors, which are kind of self-hedging, but there are, I've heard people say they don't like covered calls, right? Well, if you don't like covered calls, I think covered calls are amazing. If you don't like covered calls, you're probably not going to make money doing it. You got to find something that fits your DNA. So there's nothing wrong with, don't let anybody tell you that a certain strategy is bad or it's not going to work. Do what you're comfortable doing because you're going to make more money doing that than not. I'm not saying you should learn, you should experiment, paper trade or do small size, but people, there's calendar spreads, there's iron condors, there's butterflies, there's covered calls, cash secured puts, long options, short. There's many ways to do it, and all of them can work, or a combination. So I can't stress this enough. Do what you are most comfortable doing because you will be a lot better at it. Let's get into some more specifics. So covered calls, most of you are probably familiar with covered calls. I can't really stress covered call. There's almost no reason to not do covered calls, right? I mean, there are a few times that, let's say the market had dropped 30% during a year, and it's very likely it's going to go back up 30% the next year. That's a time when maybe just being long stock is the right decision because you might blow through those short covered call strikes. But for the most part, in almost any given year, unless we're crashing or we're skyrocketing, which is the vast majority of the time we're slowly trending, usually up, sometimes sideways, always be doing covered calls if you have the capital to do it. So if you look at the statistics, you look at some of the covered call ETFs or indexes, it's pretty obvious. You can compare the results plus the risk, to take into account risk, right? How much the returns move around and things like that. Compare it to what the S&P 500 is doing, things like, it's almost always superior, both risk adjusted and sometimes just pure return basis. You're better off with covered calls. So they're very easy. You can do it once a month, you could do it once a quarter, twice a year. They don't take a lot of time. And if you have stocks that are collecting dividends, it's a perfect complement, right? So if you're writing covered calls on your dividend stocks, you're basically getting two income streams from the dividends and from the short calls. So it's really a great way to generate income. Now, just if you're not familiar, a covered call is when you write or sell one call versus every 100 shares of stock that you own. So you're basically getting it's almost like a dividend, except if you're doing monthly, it'd be like a monthly dividend versus your long stock. So back in May, I grabbed an actual example. Like you could see another reason that I think you could say that covered calls are an obvious good strategy is that they are done in blocks, huge size all the time. So here's one of them, and this is actually a smaller one, which was 100,000 shares of Apple back when it was 186. This was like a 10-day call. This was only a 10-day covered call. Normally you do them 30 days or you do them 90 days or whatever you're comfortable with. This was just a 10-day. Someone sold the 192 and a half calls for 84 cents. So they're basically collecting $84,000 against their long stock for 10 days. So payout on something like that is that if the stock doesn't move, you just collect that 84,000, 10 days, right? So theoretically, if you were to do that every 10 days, it would be a 1.5% yield per month or 18% per year. I mean, obviously, it's not always going to work out if you do it every 10 days, but just to give you an idea, that's a 0.5% return, but that's a 0.5% return in 10 days, right, with very little risk. Now, what would happen, though, is that if the stock went up also, you would make money on that too. So then you're talking about if the stock goes up to your short call strike, 4% return, then you could see monthly 12%. Obviously, the yearly number is not realistic, but you get the idea that with covered calls is that you can make money with the stock going up, you can make money on the call itself. So that's why it's one of those situations where the odds are in your favor. Now, what happens if it goes down? Well, that 84,000 gives you some protection, gives you down to, not a ton, but about $1 downside, almost 84 cents, and, gives you that extra protection. So if the stock goes down, obviously you're losing money on the stock going down, but selling the cover call doesn't alter that. It doesn't make your losses worse, it actually protects. So once again, very low situation. The only situation here where you're kicking yourself is if Apple goes up to 210 and you've stopped yourself out at 192. But what are the chances that's going to happen in 10 days, right? Particularly if no earnings are involved. So that leads me to the pros and cons. So almost any environment, cover calls are good. They're very easy. It's very easy to consistently generate income. Now, there are basically the two drawbacks are the ones I just mentioned. If the stock shoots up and you've capped your earnings, you might be kicking yourself. But keep in mind that if you get stopped out of your stock, you've still made money. It's not like you're losing money. You're just not making as much money. Really, to me, the only real con of covered calls is that it takes capital, right? I mean, think of how much money it takes I'm using the Apple example, to buy 100 shares of Apple, right? We're already talking about something close to $20,000. So you need money in order to do the cover call. You have to own the shares to do the call against it. However, if you already own shares, if you have shares in your portfolio and you're not doing covered calls, do them. So if you already have the shares, you've already had the capital, it doesn't cost you anything extra to start selling calls against them. So very easy way to increase your portfolio yield almost every year. And if it's a down year in stocks, then you're going to protect your downside to some extent, depending on how expensive the calls are. All right, so this is that CML. We're good. This is that CML viz. This is the one with the very affordable back testing. So what I did is I did a test of 5 years from, I think this was May, holding the options for 30 days, holding them all the way to expiration. You could see I just did some theoretical. So the 45 delta, that means 5% out of the money from where we are. So it would be, a couple strikes higher than, if Apple is, if let's say Apple was 190, so then we're talking about, what's that 5%? It's like, it's not quite $10 higher. So let's say it's 190, you're selling the 200 call. That would be an example of a 45 delta call. You could see over 5 years, don't necessarily look at the money, look at the return and look at the wins versus losses. 43 wins versus 20 losses. Over that period, you've made 90%. And these are all realistic. 30-day holding period, holding to expiration, that's very common. We're not talking about something that's purely theoretical. This is a real, you could totally do this strategy, right? I just picked some random stuff. I picked a bank, I picked JP Morgan just to show you the difference. 46 wins compared to 17 losses, 80%, and then SPY, very common. SPY would be a very common thing for people to write covered calls on. Index calls work just as well, ETF calls as individual stocks. 50 wins, 14 losses, 76% return. So I could have probably picked just about over the last 5 years where we've mostly been sort of either up a lot or sideways. I mean, cover calls in just about anything would have worked. But we're talking about 5 years. We're not talking about some fluke period, right? I didn't cherry pick, I just did the last 5 years. Most years are like the last 5 years. Maybe not quite so low volatility, but still. It would have been hard to lose money on cover calls with just about anything. All right, so I mentioned at the beginning that there are many different ways to make money doing options. If you're gonna be a long options trader, and I definitely do long trades, you know, it's not my bread and butter, but I certainly throw long trades into my trading service. I almost always use vertical spreads, which is basically you're buying a call, you're buying a put near the money, and then you're selling one higher if it's a call, selling one lower if it's a put, and you're doing that to keep your costs low, right? So if you're doing a short-term or a medium-term trade, you almost always want to do a vertical spread instead of just buying the call or put outright. My rule of thumb is that if your long option is more than 50 cents, it's probably worthwhile to offset that cost. I mean, give or take, right? 50 cents, 75 cents, definitely over $1. I usually cut my costs if I'm spending more than 50 cents on a long option. But, you can set your own sort of level, but I would say at the very least, if you're spending more than $1 on an option, you want to offset that. That doesn't include long-term leaps. If you're doing a long-term option, you don't need to do a vertical spread, because at that point, it's almost like you're buying a stock. If you're doing a couple-year option, you're basically trading leverage, which is the point of the option, for dividends, which you don't get by holding a leap. So if you're doing a long-term option, that's a different story. That's kind of like buying stock. So I wouldn't use a vertical spread for that unless you are feel really strongly that a certain stock is not going to go past a certain point, even in a couple-year period or something like that. But usually over a couple-year period, we don't have those sort of targets, right? So short and medium-term option, vertical spreads. So let's look. And the best way to look at the power of vertical spread is an example. So I stuck to Apple, and again, this was an actual trade that showed up on the block screener. When the Apple was at around 185, someone bought the 195 200 call spread for a total cost of 159. So you can see with a vertical spread, that makes the break even there down to 196. And then you compare that to if you bought the 195 calls straight up for 552, the break even is so much higher. It's 200, right? So we look at, you can't calculate the max profit if you're just long a call, right? Because theoretically it could go up an unlimited amount. But your max profit on a vertical spread is 214% there, just because you've lowered your cost so much. You're only spending 159, you can make 341, right? So the beauty of this is that your max loss is 159,000. Look at the max loss for the regular call. It's 552,000. So you lowered your break-even point with a vertical spread. You've significantly lowered your max loss. You still have very good, 214% gains. It's still really good upside potential, right? And with the only real drawback is that if Apple were to explode, so that's for September, so you do go through an earnings period, if Apple were to explode to, 210 or something like that, you would cap your gains. But right now, Apple was in the 190s, I believe, last week. So this spread is probably making money, this is a couple months later, and if the spread is still on, it's probably making money. And it's looking pretty good right now because we're going into an earnings period with the stock pretty close to the long strike, right? But not way over the 200, not way over that short strike. So let me go to the con first. So this is what I've been talking about. This is a chart from Market Chameleon. You can cap your gains. You can see the red is just the cost of your spread. That's where you lose money. Once you get to 195 or 196, 59 or whatever that break-even point is, you start to make money, and then you can see the green line caps out. So above 200, it's capped. But the big thing there is that red line. It goes a lot closer to zero than it would be if you were just long a call, right? So the pros, it reduces your risk because it costs a lot less, and it's higher returns because you're spending less. When you make, if you make more money, it's generally going to be a higher percentage. So you can increase your volume more than you might on just a regular call just because it's so much cheaper. And then using the back tests, again, don't want to belabor this point, but just looking at the difference between naked calls and call vertical spreads on, this was Facebook, I picked the at the money, I picked the 45 delta call, and you can see doing a call spread versus just the amount of wins and just the huge percentage differences just between doing it. Although this next one really I think is better. This is Tesla. So this is one where you would have lost money. But look at the difference between buying puts just by themselves and then buying put vertical spreads. Like you can see on the bottom there that the loss percentages are significantly lower with the vertical spread because you've lowered your cost than if you just done the puts themselves. So by the way, the CML Viz software is great. I mean, if you ever want to test your strategies and just kind of compare, it's such an easy way to do it. It takes 30 seconds to input the stuff you're looking for, and just really gives you an idea of how your strategies. I mean, you could do things like iron condors and straddles and cover calls, and it's really good for just for testing some of your ideas out and seeing the differences. All right, number 4. We still have about 20 minutes, so we're good. Okay. Use short vertical spreads for credit trades. So now we're going to flip that around. I was just talking about long vertical spreads. Now this is short. The only difference in the actual mechanics of it is that you're selling the at them close to the money, and you're buying the further away. So if Apple's at 195, you're selling the 200, you're buying the 205 as opposed to just flipping it, right? So, however, it's a very different trade. So a vertical spread that's long is a directional trade. A short vertical spread is really, it's a volatility trade. It's a movement trade. You are generally expecting it not to move that much. However, you do have a directional, so if it was, let's say, an iron condor, well, actually, let me wait, I'll get to iron condor in a minute. So you're selling the closer to the money, you're buying the further away. It's a volatility trade, but it does have a directional bias, right? Because you're only doing one side. If you're selling a put spread, you make money if it stays still or if it goes up. And with a call spread, you make money if it goes down or if it stays still. Now, if you get comfortable doing it, you could do what's called an iron condor, which is probably my bread and butter, although I do a lot of somewhat directional credit spreads too, but an iron condor just is a call spread and a put spread around a range that you expect the stock to go in. So if you think something's going to be range bound, a condor is just a combination of two vertical spreads. So I use those a lot. That is truly a market neutral sort of trade or volatility trade. Credit spread, you can lean to one direction. I mostly use them on the put side if a stock or ETF or something drops a lot for some reason, and I don't believe that drop is going to continue. Let's say earnings is the classic example. Earnings come out, they're pretty solid, but they're just not what people wanted, and so they sell off the stock, maybe like a sell the news sort of situation, but the stock is still a good stock. To me, that's a situation where volatility's high. I'll sell a put spread underneath it when I think it's done falling, and then it'll either just sit there or it'll climb back up. Something like that I use all the time. Call spreads are a little bit, you don't necessarily have the volatility on the call side of stuff, sometimes with tech stocks, but generally I do these with puts. So it's a very common strategy. Well, let's look at an example, but you could use these on stocks, you could use them on ETFs, you can use them on indexes. So I looked at IWM, this is just recent, this is from July 5th. So here, huge block trade, 19,250 options. So that's with IWM at 165, someone sold the 163, they bought the 155, and they collected 111. So what you're doing is you're collecting premium. That's the money you would make on it. So from 165, you would break even there, 161.89. Below that, you would start to lose money, but you're capped down to 155. So the premium, the max profit is in this case it was 2.1 million, $1.11 times those 19,000 spreads. Anything above 163 on July 20th, which was just Friday, right? And IWM was, what was it, 169 or something like that. So this person made out, right? Assuming they didn't close it, they collected all 2.1 million, right? It really never came close to being a losing trade during this period. Now the difference is that your max loss is the gap between the two spreads, so $8 minus whatever credit you received. So yes, max loss is 13.2 million, right? But that would have meant that IWM would have dropped 6% in 2 weeks, and that's the sort of activity that, that happened in February, but it's not the sort of thing that we're used to seeing. Now, obviously, someone who did this much research, they were looking at the events that could come out in July and things like that, and they were obviously saying, all right, I don't see a lot of downside catalysts. Now, the thing is that it didn't have to go up for this to make money. It just had to just sit still. That's what's great about these trades. So they're extremely high probability. So the losses look kind of scary, but you're doing a trade like this, you've already done your research. You don't expect it to go down a lot. And if it does, you know what your total risk is. Plus, usually you have time to make an adjustment, roll it out or down, or buy an extra put or something like. It's usually something like this doesn't just happen overnight. You have time. So I use these a lot. And the key here is that you have that long strike. Now, I wouldn't do an 8-wide spread. Now, this is a well-funded person who could afford to take on risk and can lay off risk in other areas. I do narrower spreads because it lowers your max loss. But the key is that you need to do, instead of just selling a put, you sell a put spread, because not only does it cap your risk, but it's a huge deal for margin requirements, right? So in order to sell a vertical spread, you have to have a margin account. So you have to have, at least $2,000. And if you leave those open-ended, it takes a ton of margin, right? I don't know, depending on your broker, it's different situations. But with this, your margin is only what your max loss is. So in this case, it was a lot. But the idea is that, you don't want to eat up all your margin doing short put trades when you can do a spread and do a lot more trades. So the pros are that you can trade volatility pretty easily, slight directional bias. It works in the sideways or neutral market, which is why I like them. So you can move them. So that one was relatively close to the money. 163 was the short strike with the stock at 165. But you could do it. Let's say you don't mind, making quite a bit less. Let's say you only want to make 50 cents instead of $1.11. You might have been able to go down to, somewhere in the, 150s or something like that, and increase your probability by a ton and just taking less. So you can move your spreads around and change your probability quite a bit. Now the cons are it requires a margin account, so usually level 2 or level 3 permission, and then the max loss is much greater than the max gain, but that's because your probability is so high. So when you're dealing with 70-80% probabilities, you have to be able to put up some money in order to get that kind of probability. But generally, you don't have to worry about losing, but the risk is there. You need to be aware of it. So as always, the best way to look at this is to look at the actual results. So this was selling a 30 delta. I like to use 30 or under delta when I sell vertical spreads. Sell the 30 delta, buy the 20 for protection. I looked at SPY, NVIDIA, VXX, which is that volatility, UNG, which is the natural gas. I just kind of picked some stuff. So these were 30-day spreads, held to expiration. Maybe not, a lot of people like to close their short trades before expiration, so maybe you wouldn't hold this until they go to zero, but you might hold it relatively close. This was 3 years of results, and then again, like with a vertical spread, you want to have some directional opinion, not a ton, but you want to have at least an idea, right, that if the stock is going to move, it's going to go more likely to go one direction than the other. But you could see what I want to call attention to is mostly the wins versus losses, just the high probability trades, right? 34 versus 5, 30 versus 8, you know, good returns. But I mean, just look at the wins versus losses. That's, you're going to lose on occasion, and the key is that besides having good risk management behavior, you win so much more that it's okay. It's all right to lose occasionally, right? Everyone does, but you want to win a lot more, and as long as you're smart, which you are with vertical spreads, right, because you're capping your loss, then you're going to win so many more times that you'll end up making money. All right, so the last one is kind of just some tips, 6 tips to improve your success rate. The first one may be obvious, but if for anybody who's traded options regularly, trade liquid options. So what I mean is that it's nice to find, you know, some like hidden gem of something that doesn't trade a lot that you think might be going up or down or whatever, and nothing wrong with doing that. But keep in mind that if it doesn't trade a lot, you're going to have to pay for those options. The bid-ask spread's going to be wide. You're going to really need it to move in your favor. Like if you look at a SPY option or an Apple option, the ones at the money in the front month, they'll be like a couple cents apart. Like you're basically getting it for fair value, right? Where if you do some, you know, random stock that has options but doesn't trade that much, you know, you might give up 50, maybe not 50 cents, 25, but maybe depending on how expensive it is, 25 to 50 cents on an option. So you're already going to be in a losing situation. There are times, of course, if you have a strong opinion about something and you really want to trade those options, then do it. But just keep in mind that if you're going to be trading regularly and you're going to be doing active strategies, you want to keep your bid-ask spreads as narrow as possible. You don't want to give up that much edge if you're trading that often. All right, now I've talked about this a lot already. Look at the tape. So big trades like that 19,000 lot trade, which obviously worked out, you know, where that person made 2.1 million if had they hold, you know, assuming they held it. Like those block trades, when someone's spending that much money, they usually come from someone with a lot of capital, with really robust research, you know, either divisions or people or whatever. So smart money plays in the option space. They have, you know, funds, trading desks, you know, people with a ton of money and a ton of smart people and a ton of research. So when you see really big trades, a lot of times they are good clues as to what's going to happen. You know, I felt pretty good that IWM wasn't going to go below, you know, 163 or whatever that strike was once I saw someone, you know, putting up 20,000 options over a, you know, what was it, like a 15-day period, right? Like someone obviously with a lot of money and brains felt that IWM wasn't going to go down, and it didn't. So that happens more often than not. Market Chameleon that I mentioned is a good site to look at block trades. I believe that most of their block trade screener, I believe, is completely free. Option sentiment, so basically how many calls versus how many puts, or how many short calls versus long calls. You know, basically bearish trades and bullish trades. You can find it on Market Chameleon, great site for that. The amount of calls versus puts, sometimes you have to take into account, well, is someone just hedging? And you know, it's a little noisy, but if you're looking at particularly a stock that doesn't necessarily trade all that much, and all of a sudden it's got a lot of volume, see if it's the calls or puts trading, particularly before earnings, because that means someone's got a pretty strong opinion. So again, trying to time a direction, always difficult, but looking at, again, like particularly before earnings and things like that, looking at the number of calls and puts that have traded is a decent clue. If it's around 50-50, then you know nobody really knows what to expect from earnings. But you know, I'm just using the earnings as an example. But if it's like 80-20 calls, the crowd is expecting good earnings results. More often than not, it's going to be that way. Of course, there's always surprises, but you know, there is that 20%. But it's just another tool for your toolkit that I recommend. Don't trade teenies. That's what I mentioned earlier about 5-cent. Teenies are the sort of the colloquial term that we used in the pit when things used to trade in fractions. 1/16 was the lowest it would go. It wasn't by pennies, it was by it was by 1/16, which is about 6 cents, and we call those teenies. And the idea is that, there's almost there's better ways to take sort of lottery ticket trades on options than buying the cheapest, these 5-cent options. It's just never a good idea. Don't ever do it. Unless you're using it to cap your margin or something and you just need you have some kind of short trade and you want to trade a 5-cent option just to cap your margin or something like that. That would be the only reason I could think of. All right, so I mentioned this in the last part, but selling options for a credit is extremely high probability. That's mostly what I do, but you have to understand your risk, right? Like if it goes against you, you have a chance to lose a lot of money, and you have to be able to manage your risk, make adjustments, things like that. But generally speaking, you're going to win, and if you can manage your losses, you're going to win more than you lose. So also, like I know plenty of people who don't like selling options because of the max loss potential, and they just don't like have that. They don't want to have to worry about adjusting. They don't want to do things like that. So if you're not comfortable selling options, then don't do it. And then always understand the underlying product. So this may seem obvious, but with those, like when at the very beginning, I'm talking about XIV exploding, it died, right? Imploding, actually. If you had read the prospectus, and not that anybody reads the prospectus, but if you read the prospectus, you could have seen that it was possible that they could shut it down at any time if they had to cover their risk and they couldn't afford to do so. So just know your products you're trading, particularly if it's an ETF, know generally what the components are. All right, so summarizing, trade your edge. So for me, my service, mostly iron condors, credit spreads, and then I throw in long trades every once in a while if volatility is really low or I just see something that I like, right? That's my edge, is mostly trading volatility. But if you're a directional trader, by all means, do that. You can do it by selling options, you can do it by buying options, but do what you're most comfortable with. Use covered calls whenever possible. Please, if you own shares and you have at least over 100 in your accounts, particularly retirement accounts, things like that, if you have that many shares and there are options available, look into covered calls. Not 100% of the time is it worth it, but I would say 95% of the time you're better off selling a covered call. Please look into that. Use vertical spreads for directional trades in the short and medium term. Conversely, if you want to start trading for credit, I would start with short vertical trades. If you get more comfortable, you can move to iron condors. And then those 6 tips for options trading success, that last slide, look at block trades, stick to liquid options, things like that. So, all right, a couple minutes left. So, options profit engine, just briefly I mentioned, that's my service, my main service. Iron condors and credit spreads are my bread and butter, but I will do long trades in there. I just introduced butterflies, directional butterflies, because they've been pretty good. And then I also have our dividend guy and myself, Tim Plain. We have a covered call service that we each switch off every week doing covered calls. He's more of a dividend guy, I'm more of a growth guy, but we do covered calls every week. So that's called 30-day dividends. So if you sign up for the presentation, you can get information on that. I will also have I'll put up a bunch of business cards up here after I'm done here. And then for Options Profit Engine, you can just go to that site. So, all right, well, we have a couple minutes, so questions? Yeah. The question is, do I hedge my iron condors with extra call options or extra put options, if that's the case? I usually do not. It is a way to if you have an iron condor and you find it moving against you, buying an extra call or buying an extra put can be a good way to do it. I usually don't adjust unless I feel like I absolutely have to, and if I do, I usually use a vertical spread. You can just like double the amount of calls for protection. I like to do an additional vertical spread usually, or roll one side, not as often, but I tend to not adjust my condors until pretty close to the end. I usually like to wait and give them a chance, unless some news comes, some major news comes out and, you know, there's one direction is up, then maybe that's an obvious situation, but it's normally not what I do. Yeah. Sorry, can you repeat that? Okay, so the question is what percentage of the max P&L do I close out with on the iron condor? I usually, my level is usually about 20 cents. So if I sell, I do generally 15 or 10 delta iron condor. So my stuff is not generally juicy and premium. $1 is about as much of a premium as I'll go. It's usually closer to 70 to 90 cents. I will usually sell out at 20 cents unless like it's a really wide condor and it hasn't moved at all and there's just no news on the horizon. Sometimes I'll hold it, but 20 cents is kind of my level, 10 to 20 cents. I pretty much never let anything expire, though. Yeah?
What's the lowest amount that you would typically pay for correction protection on a put?
That's a good question. So the question is, what's is it the lowest amount?
What's the maximum amount that you would pay on a correction put?
Maximum amount to pay on a correctional put. Well, first off, I would use a put spread. Again, like that way you can ramp up your protection. You know, it's a good question. I don't honestly have a direct answer because to me it depends on the volatility environment. If volatility and the metrics around volatility are moving higher, then I would definitely be willing to pay more. Counterintuitive, I know, because things get more expensive, but if volatility is scaring me, you know, and you have the VIX curve being inverted or something like that, I would do a put spread so you can lower your costs. You know, I don't have a set percentage for you, but I mean, I don't like to spend more than $1 or so on any spread per se, but again, like if you're really worried, I mean, I usually do 5 wide spreads, so I probably wouldn't do over $2 on that, but if it's a 10 wide spread, you can go a little bit higher. So it's a complicated question. If you have more specific things, you can email me, but because I think there's a lot of variables there, so I don't want to just give you some set number. All right, I'm out of time, so if you guys want to talk, I'll step to the side here and you can finish up your questions. So thanks everyone for coming. I really appreciate it. Thank you.